So if you don't mind, we'll get started because we have a very, very packed, wonderful, but packed program today. So I will be saying my biggest thanks at lunch to Citi, our partner, and to the other sponsors who contributed to this event. And without any further delay, I'd like to say thank you to everybody for being here and invite Christa Volpicelli. She's the Managing Director and the Head of Investment Banking for Shipping for Citi. And I'd like to ask Christa to come and open the conference. Christa, the floor and the podium are yours. Thank you.
Great, thank you, Nicolas. First of all, I'd like to say a big thank you to Nicolas, Olga, Elena, and the entire team at Capital Link for hosting this fabulous forum, having us here today. Citi is proud to partner with you very consistently through the years as you put these forums together and bring together some of the best and brightest of our community to debate some of the topical issues of today. Secondly, I'd like to welcome all of you here today. It's certainly a packed agenda. For those of you who are new to the industry, it will be an excellent crash course in everything you need to know about all the sectors of shipping and the various capital providers of our times. For those of us who make a living in this industry, it's a fantastic forum to debate the current topics of today and catch up with old friends. I would observe that over the 10 years that Capital Link has been doing these conferences, the capital markets, and in particular the US capital markets, have been playing an increasing role in the international community of ship owners. This is evidenced by the fact that many of the companies participating in the panels today are US publicly listed companies. And as such, I thought it was appropriate to open today by starting out revisiting how some of these companies have been performing, and then transition into some of the themes that undoubtedly will be discussed and debated throughout the course of today. Recognizing we are a quarter into 2016, I do believe it's relevant to start by looking back at 2015 performance, because in the face of flat overall US equity markets, we saw only one sector of shipping outperform, with the tanker sector up 13%. Some players in the tanker sector were up 30 to 50% in the backdrop of what was one of the strongest charter environments in some time. But the story in other shipping sectors was quite different. Even businesses in the maritime MLP space, which over the past several years have seen some of the most consistent access to the equity markets, saw significant deterioration in values. But I would point out that if you look across to the energy sector and the broader MLP indices, the MLP sector was down a similar amount, trading basically in high correlation with the price of oil. The declines across most names in our sector occurred mostly in the second half. The bottom graph of this page shows first half 2015 equity performance, where you can see quite different numbers. From where we ended 2015 through today, we have seen further drops in valuations, as well as a market backdrop that has been defined by volatility. But it's important to point out that there's been quite divergent performance within some of the sectors. The bottom two numbers on this page show the stock price performance of the best performer in each index and the worst performer. So for example, whereas the MLP sector as a whole was down 8%, you had one company up 26% year to date and another down 50%. So faced with average lower valuations and higher costs of capital, it's not surprising that in 2015 we saw a drop in the magnitude of US equity issuance in the shipping sector, with just under $2 billion raised in the US markets. This is a drop of 60% when you compare it to the previous year. It's also important to note that all of this issuance occurred in the first half of 2015. We saw 2 IPOs happen last year in the tanker sector. We saw 2015 begin with several dry bulk companies issuing capital to help them sustain their balance sheet through a persistent downturn. And it's amazing we started 2016 in a similar manner. If we look at the overall US markets, both equity and debt, you will see that 2016 has certainly started out in the first quarter with declines in overall volumes of issuance. There's been 27 billion of equity issued year to date in the US so far. This is a decline of 60% when you compare it to a similar period for 2015. This includes IPOs, issuances of existing companies, and convertibles. When you look at the non-investment grade bond and leveraged loan market, you see a similar trend. So let me transition into some of the themes which are behind these numbers. And I'd like to divide these themes into two parts: those which are under the control of companies and ship owners, and those which are external factors. So to start, there are many elements you see up here which are under the control of businesses today, which influence the returns a company is able to earn for its shareholders. Whether it's asset type, size, chartering strategy, age of fleet, quality of counterparties, dividend policy, any external capital provider, whether it's equity or debt, will seek to understand these factors and will compare them when determining who to back and what is the cost of that capital. But as we all well know, there are many other elements out of the control of a shipping company. And I would argue that in the last 12 months, some of these factors have been more prevalent in terms of driving the cost of capital upwards for the industry overall. Within a capital-intensive industry such as shipping, how a company navigates all of these factors will ultimately drive its cost of capital and relative advantage for shareholders. Stated differently, I believe that a differentiator in these challenging times is the ability of management team to fine-tune their strategies to adapt to the factors you see on this page. As we look forward to 2016, undoubtedly, there will be volatility ahead, and these external factors which you see up here in red are likely to continue to challenge the cost of capital in the industry where we serve. But in this volatility, I believe there's significant opportunity. There's opportunity for investors to invest in companies whose valuations have fallen to levels which are analytically not justified when you look at their financial statements, their balance sheets, and their cash flows. There are opportunities for ship owners and for companies who are well capitalized with strong balance sheets to continue to execute on plans to drive long-term value for their shareholders, whether that's through M&A, whether that's through continued asset transactions, whether that's through deleveraging their balance sheet. Over the 10 years of being present at this forum, much has evolved. Banks remain the dominant form of capital, but have become more disciplined. The capital markets have played an increasing role in providing capital to our industry, but valuations have become more refined. Private equity is here, and there's much debate over what that means. The themes reflected in the words on this screen continue to be discussed and debated. And so as we begin the forum today and we revisit these themes again, I would like to pose the following question for us all to consider, which is how can we embrace these volatile times of today and to continue to ensure that capital is allocated responsibly to facilitate the ship owners and the companies of our great industry to continue to thrive. So with that, I'd like to conclude. Thank you for listening. I look forward to speaking with all of you here today and having an excellent forum. Again, thank you to Capital Link.
Well, I'd like to say thank you to Christa for various reasons. First of all, for delivering an extremely compact and interesting opening presentation and setting the theme for the overall conference. Secondly, I'd like to thank her for keeping the time. Actually, she finished a minute and 30 ahead of her time, so that shows you the efficiency and effectiveness of Christa. And before inviting Tobias Levkovich to the podium, I would like to say that, and I will repeat it at lunch, we're gratified that this year Capital Link celebrates our 20th anniversary. And it's the 10th anniversary of organizing our shipping forums, so we're really gratified to see that on this landmark occasion, we can partner with Citi for this event. So thank you, Citi, thank you to everybody who contributed, and of course, thank you to you for being with us. And I would like to invite Tobias Levkovich. He is the Managing Director and Equity Strategist for Citi to guide us through the equity markets and the economic landscape. So here he is, and thank you for being with us.
I feel like I'm running for office. In fact, I might get a lot of people who would prefer that I run for office. And like Ted Cruz, I'm also born in Canada. So I'll move off the political humor at this stage and move on to something I probably know a little bit more about, which is the markets. So I love starting my presentation with this particular slide. In fact, I've been using this slide for about 10 years. Now, there are two reasons for that. One, I do think that it shows the perennial battle between the bull and the bear in markets, but also, you may have heard that Citi at some point in time in the last several years had some financial issues, and I still haven't gotten a budget to, update my slides. But nonetheless, if you look at the slide, you're going to see various things here. And what I really want you to focus on is the line underneath the bull and the bear, what I call the exploiting the gap between perception and reality. If you really want to know how to make money in markets, that's the answer. People believe all kinds of things. They're relatively untrue, but they like to believe it anyway, and I'll prove to you a couple of them as we go through this. But let me give you a perfect example of perception-reality gap. I, like you, get up in the morning, go to the bathroom, brush my teeth, wash my face, and I look in the mirror and I see Brad Pitt. So clearly there's a perception reality, and you all need to talk to your eye doctors about improving your corrective lenses. But again, people perceive things the way they want to, and that's really critical. So from a perspective of what we think are going on in markets, we think that the market will be up about 5% this year with a 2150 target on the S&P 500, pretty much in line with earnings growth of about 5%. There was a comment on the earlier speaker, Christa was talking about the energy sector being under pressure, and actually last year, if you took out the energy earnings drag from the S&P 500, earnings were up about 3 to 4%. Now, they would have been even up higher if it hadn't been the strong dollar also dragging down earnings numbers. Both of those factors are going to kind of, if you like, anniversary themselves by mid-year, and we should start seeing a better trend. So for example, in the fourth quarter, the trade-weighted dollar was up about 14% year over year. It'll be about 2% by the middle of the year. And in that context, you don't get these very substantial drags on earnings. And there were a whole bunch of companies that saw their revenues held back 7-8% in the fourth quarter simply because of the translation of the dollar. They sold more product. So in other words, there was underlying demand, but people didn't really see it in terms of the way they reported their revenues. Now, having said that, if you look at the relationship between the stock market and earnings, and in this case, the blue is the stock market, the red is the operating earnings, and you'll see kind of in the latter quarter or so of the chart, or third of the chart, you'll see where the blue really spikes above the red. That was the tech bubble of the late 90s. And if you look at the more recent period, and this is about 2011, 2012, you saw the blue not catching up to the red for a while, and that was the periphery debt crisis in Europe, as everybody got nervous that another financial crisis was going to occur, and they weren't going to pay for the earnings because they weren't going to be sustainable. By 2013, that didn't happen, and the market caught up to the earnings. So what you really see is earnings matter a whole lot, and sentiment matters a tremendous amount as well. If we get overly excited, as we did in the late 90s around the tech bubble, or we get overly concerned, as we did during the periphery debt crisis, then the market can get out of sync with earnings. And to a certain degree, we've had a little bit of it more recently as people got overly worried back in January about another recession. And I'll say overly worried because I'm going to paint a picture that suggests something totally different. Now, we track sentiment very, very carefully. We care deeply about not how people act, how people feel, but how they act. So we never ask our clients how they feel. My wife will tell you I'm very insensitive. I really don't care how people feel. What I do care is how they perform. What do they do with their portfolio? So we created this panic euphoria model to determine how investors position their portfolios. Now what's fascinating is the line, not the gray part, but the line actually got below where we were in early 2009 when all of us were feeling back in February, March that we're right at the cusp of this horrific new depression. And I don't think anybody feels that way today. But actually the sentiment in the market, the positioning of the market was actually worse in the last month than it was back in the first quarter of 2009. So you kind of wonder why, and there are two simple reasons. One is that we actually experienced 09, and as a result, we're fearful of experiencing it again. We make judgments as human beings based on our experiences. If we never experienced something bordering a depression, because most of us weren't alive back in the 1930s, then we can't actually put that into our mindset. But once you go through the experience, you do start worrying about a recurrence. The second aspect is that investors basically were so petrified about the lack of a potential backstop. There's credibility concerns about the central banks globally. Have they run out of ammunition? Have they used their wad already in terms of all the aspects? Even negative interest rates have not generated the kind of, if you like, response that people have thought it might do in places in Europe. So from that perspective, this greater fear is, at least back in 08, 09, we had the central banks to back us up. We're not convinced they're there today, and certainly we're not that convinced that fiscal policy will be able to fill the gap, given, for example, in the US, Democrats versus Republicans agree pretty much on only one thing: they hate one another, and in Europe, you've got to get at least 18 countries to agree on anything, which is not something that's going to happen overnight. So from that perspective, people feel a little bit more concerned. Now, when we're sitting down on that blue line under the, what I would call the aqua line, you're in panic territory on our panic euphoria model, it generates a nearly 97% probability that markets are up in the next year. I don't know about you guys, but I kind of like numbers that border 97% probabilities. I wish I could get that at a craps table. Now, what's negatively going on? And I don't want to just tell you the world's a wonderful place. There are some things we're monitoring carefully, one of which is the credit tightening environment. So this is the central bank's, the Federal Reserve Board Senior Loan Officer Survey for commercial and industrial loans or business loans. And you can see that the blue line has fallen. It means the credit has gotten tighter. And usually with about a 9-month lag, you get a response in GDP. Now, why am I not petrified of this chart? Well, there are two reasons. One, the blue line's not plunging like it did in 1999 or in 2007, 2008. And that meant that credit was tightening up very, very rapidly. The second thing that's very different is that when we go into the qualitative discussion, when you look at what the Fed's report actually says, most people are citing, or most of the banks are citing, the energy sector. It's not a widespread event. And number three, we can see this through the National Federation of Independent Business survey when they ask the small business people, are you seeing credit harder to get than the last time? It's edged up, but it hasn't moved up a lot. And history shows that you need at least a year's worth of tightening before you get a recession. So this is a concern. We're monitoring it. We don't want to see it get much worse, but it is something that has not developed to the point that you would arguably say, hey, the end is near. Now here's another way of showing what's been happening in the credit market. The red bar here is the high yield credit or costs for energy, and the blue is for everything other than energy. And you can see this incredibly wide gap that's opened up between the two lines. The market has been very sensitive to the energy issue, despite some of the fears about liquidity in the financial markets, particularly in high yield. The market has actually been fairly discriminating between what they see in the energy market and cash flows for energy companies, particularly highly leveraged ones, versus the rest of the sector. Now the problem is that people extend this to the broader markets when they see high yield. About 24% of the high yield market is energy and mining, so the resource industries, if you like. That's about 8% of the S&P 500 and about 3% of the Russell 2000. So it's overly represented high yield. Do not extrapolate high yield to the rest of the market, but people do because it's a good story and people like to be controversial. Having said that, what about the ISM? Well, manufacturing, the PMI has dropped below 50. Now, most people don't know my background in this room, but I spent 15 years as an industrials analyst before I moved into strategy in 2001. welcome to my world. Okay, when you're looking, this is the 14th time since 1990 that we've seen the PMI drop below 50. In the prior 13 experiences, 3 of them ended in recessions, 10 did not. This is a very bizarre game that you're playing when 3 beats 10. On that basis, Texas A&M lost yesterday, for those of you who watched the double overtime game. But anyway, pretty fascinating to score 14 points in 40 seconds. Here's another way of looking at the world. Industrial production data. Right now, about 41% of all groups that report into the industrial production data are showing you a decline in production, which means 59% are still showing production increases. Usually you're talking 60 to 70% talking about production declines when you talk recessions. So again, everybody's entitled to an opinion. I'm okay with that. You're just not entitled to your own set of facts. People have wondered, where's the oil price benefits? How come we haven't seen consumers spend that money? Well, the simple reason is there's about an 18-month lag between changes in energy prices and changes in economic direction. It takes that long for the average consumer to kind of understand that those prices are going to be sustained. Keep in mind, most of the people in this room are very familiar with shale oil production. They understand what happens at $30. They understand what happens at $60. They know Iran's coming into the market, things like that. The average American has absolutely no clue. And I'm not trying to be harsh on them. They're focused on their kids' basketball games. They're focused on their own jobs. They're focused on their own budgets. They're not focused on this. I have a friend of mine who's an economist, and his license plate is M1, M2, M3. It's very cute if you understand economics and money supply. And I always tell him, do you realize that nobody understands your license plate? And he says, yeah, but it amuses me. So if you ask the average person what M2 stands for, they will probably say a BMW. So understand that they have to see this ongoing change in prices to believe that it's sustainable. I'm not trying to be harsh on the American people. I know I take shots at them as a Canadian, but it's more a function of where their focus is. Quite honestly, if you ask me anything about the Kardashians and the Jenners, I pretty much don't know anything. And I'm actually kind of proud of that. If you look at hiring intentions, not about the jobs data, but do businesses want to hire? Well, this is the Small Business Small Business Data, National Federation of Independent Business Survey. The blue line is hiring intentions. Do you intend to hire? The red line is what happens a year later on the unemployment rate. This has been going on for 40 years. It's been very consistent. They tell you that they continue to want to hire. Remember, this is 80 to 85% of all new hires occur in the small business sector. So if they're telling you they intend to hire, I would listen to them, because I don't think a memo went out and said, from now on when the survey shows up, lie. What about capital spending? So this is one of the greatest mythical concepts around. You think it's unicorns in technology? No, this is amazing. So the blue line shows you capital spending, the blue bars, capital spending for the S&P 500 companies. The red bar is the buyback. So there's this view that everybody's buying back stock and nobody's spending on capital. Well, somehow tell this to the S&P 500 companies, because this is the facts. If you look at the data, it's pretty clear. Capital spending hit a record in 2011, another record in 2012, another record in 2013, another record in 2014. Through the first 9 months of the year, it's off slightly because of energy, and in all of those periods it exceeded buybacks. The problem with this data is it's global. We don't know where these companies spend their money. So let's take a company like Exxon in energy. They could have spent the money in North Dakota. They could have spent it in North Korea. No, they wouldn't have said North Korea, but they could have spent the money in the North Sea, and they could have spent it in Nigeria, and we have absolutely no clue because they don't tell us that. So we decided to take another shot at this and look at capital spending as a percent of GDP in the United States. The red is real capital spending, or real what they call non-residential business fixed investment as a percent of real GDP, sitting at about 13.5% in the red. The light blue, or the blue rather, is energy extraction related investment in the United States as a percent of GDP, and both in 2009 they hit their lows. So for the blue line, it's about 0.55% of GDP. It spikes all the way to 1% by 2012 and plunges back to below where it was when it started, and the red line continues to stay up there at near record levels. Again, you are entitled to every piece of information and every piece of misperception that you have. It is a free country. You're just not entitled to make up your own stuff, because it's just wrong. Now, I had a client ask me this in Chicago recently. Do you believe this data? Is it real? Can you trust the government data? So I had three responses. One, it's not Chinese data. Two, you can't choose to believe whatever government data you want because it supports your contention, and refuse to believe the other stuff that doesn't support your argument, because that's called bias, not analysis. And when your name is Tobias, you view it as a verb, not as a verb, not as a noun. Now, again, very few people can get away with that line. And number three, the last point I'm going to make here is, actually, I believe this data a whole lot more than a lot of others, because every quarter companies have to report their numbers. They've got to pay their taxes, and if they want to show depreciation charges or take advantage of investment tax credits, they better be showing invoices for stuff they bought. Or CFOs and CEOs who sign those documents are going to jail for tax fraud. And I would suspect that 99.5% of them aren't going to risk it. There's always that little group of people who are willing to take the chance. So again, we've got capital spending in decent shape, we've got jobs in decent shape, and we have an environment where credit isn't blowing us up. So how do you invest? Well, one of the things we tell investors is to buy right now large caps over small caps. And that's been getting us a lot of pushback. We're going to show you in another moment that we like, well, I may as well show you now, that we like value stocks over growth stocks. So I get pushback from investors. This sounds like a very risk-off type of environment. If you're buying large caps or you're buying small caps versus small caps, if you're buying value over growth, this is risk-off. Quite honestly, the biggest plays right now in places like value or banks, energy, materials, I don't think anybody being told to buy a bank, an energy stock, or a mining stock would be viewed as risk-off. Okay, that's a hard one to get to. And a whole bunch of large caps wouldn't fall under the risk-off, things like FANGs. So I just find it fascinating that people want to say and want to discuss what they want to discuss. They believe what they want to believe. I spend my time trying to find those opportunities between them. Now, I didn't put slides together, and we'll put all these lovely disclosures. I'm sure you can read them. Our lawyers have to make a living. Wow, there are a lot of them. The thing that I want to just highlight, I didn't really put up the material, the transports here, because for one reason, I've been actually negative on the transportation sector over the past year. It's been the right call to make recently. A lot of this has to do with the heavy weights of railroads and commodities, and we were quite negative on the whole commodity space, believing that there was a significant amount of excess capacity. That is probably starting to get in line. We did move the material sector to a neutral late last year. I have no idea what I'm going to do with transports. I do a review every quarter, and we'll see what the data kicks out. We have had a couple of names that we've liked. Chris Weatherby, our analyst, is somewhere in this room, I suspect, and we supported him at least on one of his names. So with that, I'm going to try to keep to my promise of keeping tight schedule. I want to continue the practice that we had. I don't know if you have time or want to handle any questions, but you tell me.
One is on that last chart you spoke about, the CapEx chart. Is that domestic CapEx, or could that also be international CapEx?
Well, that was the point we were trying to make. The original chart we showed you that showed you the blue bars, that's global, because S&P 500 companies don't break that out for quote-unquote competitive reasons. So that's why we separated out the U.S.-specific business fixed investment as a percent of GDP and energy as a percent of GDP. There's this perception, and the reason we put it out was there was a perception that all of the growth in the U.S. had come because of the energy sector. In fact, I was in Texas recently, and they told me, well, all the good jobs came in Texas. And I said, thank you, Governor Perry, and moved on, and just said, actually, that's not true. 15% of all housing starts occurred in Texas, which means 85% of them occurred outside of Texas, and those are pretty good jobs if you think about plumbers, electricians, framers, things like that, masons, very, very good jobs, and I suspect the other 85% did not occur in North Dakota, which is a pimple on the country.
Okay, and then you had talked about S&P operating earnings, and, you know, Can you put a little color on GAAP? Because GAAP earnings Q4 were like $18 and change, I think, which is like a $70-something
I think
run rate.
GAAP is one of the stupidest concepts I've ever heard of. I'll give you an example. When I first started doing the strategy job, in 2001, 2002, you had a number of technology companies that took massive write-offs. So for example, and I actually, being my Canadian background, have I said that before I'm Canadian? Anyway, I realize that I say it a little too often. There was a South Park movie, and there was a song in the movie called Blame Canada. And I wrote a report called Don't Blame Canada, because at the time, Nortel and JDS Uniphase, two Canadian companies in the S&P 500, took write-offs that wiped out the S&P 100's earnings. In other words, Walmart didn't make any money anymore. IBM didn't make any money. Exxon didn't make any money. So I think GAAP just totally misrepresents the data. If you have big charges taking for things like impaired goodwill, it screws up the entirety of it. Now, what I will tell you on the earnings numbers, there's a vast gap between everything. So last year, GAAP numbers, 2015, $86. S&P 500's interpretation of last year's earnings were $100. Bloomberg's interpretations were $110. And First Call, Thomson First Call, or Reuters, is $118. So choose the number you want. I mean, I tend to use the First Call numbers because I've been using it for 25 years in my career. First Call tends to take the aggregated consensus numbers, what most analysts believe the numbers are, not individuals or a reported number that isn't representative of what you're buying as an equity holder. So I think GAAP is just not a particularly useful one. But if you wanted to use GAAP, that's fine. That means next year's earnings will be up about 30%.
What percent?
So 30.
On GAAP, okay.
Yeah,
thank
on a
you.
GAAP basis, because you're starting with such a low, when you end up $121 is the consensus bottoms-up number off 86. So just do the math, you're paying a very, very low PEG ratio if that's the case. That's the problem with GAAP. It tends to get very screwed up at inflection points, particularly big charge periods. Last one, if there is one. There's one right here, and I'll take this as my last question. Sorry.
Can you bring up the charts and go back to the unemployment chart, the sentiment or the belief that small business owners are going to employ people?
Yep.
I mean, the chart looked like it spiked around, and it didn't look very different in a way between the sentiment of the small business owners and what who they were going to employ versus what the unemployment numbers were. And
No, it looks like it's going to stay at about 5%. It spiked, it pulled back, and then spiked again.
have you done the spade work on the definitions of what the headline is in the headline unemployment number? It's now only down to if a person's on unemployment benefits for 4 weeks. So if a person's unemployed for 4 weeks or less, they're in the headline number of 5% or 4.9%. Whereas anybody unemployed for a longer period of time and still receiving unemployment benefits are not included in the headline number.
No, they wouldn't be.
Well, why not? I mean, they're not employed and they're on
One
unemployment
sec. If the way the unemployment number is created, I don't create it, but if you look at it, the way the unemployment data is created is, are you seeking employment and versus not? So one of the biggest issues has been discouraged workers. The people
that's
who are
way after the-
unemployed still seeking work, which means they can collect unemployment benefits. If you're not seeking work, you can't. Then you're in the data for the unemployment rate.
In order to get the unemployment benefits, you have to
You have
continue
to be seeking
You have
work.
to prove you're seeking work, and those benefits for federal
That'll
benefits
show
are
up in the
26 weeks
unemployment
alone.
rate. That'll show
It's
up
not
in-
in the headline number. I did the spade work on the definitions. Definitions are 4 weeks and less on unemployment benefits, or that they characterize and you're seeking employment, and that's only in the headline number. You're still on benefits for 26 weeks on federal benefits, and then state benefits kick in. You have to prove that you're seeking employment.
You have to prove you're seeking employment to get benefits, right? Yeah, because otherwise, otherwise you become part of discouraged workers. The biggest problem with the unemployment data, and this final statement, because I see I've got to come off, but the biggest problem with the unemployment benefits or the unemployment rate is this idea of the discouraged workers. So you have less labor participation rates. The question is, will they come back? Some will, some won't. Depends on their age, depends on their desire, depends on how much they can make. There was some work done by the Federal Reserve Board of Dallas, or of Dallas, the Federal Reserve Bank of Dallas, sorry, that suggested there was only about a 10% differential between all the benefits you can get versus minimum wage. And that's unfortunate that it's gotten to that point. They haven't published the data because they don't want to create a political controversy on it, but they have done a whole bunch of work on it. It gets too political, and that's why I don't like going down that path. But I think some people will come back over the next 4 or 5 years, which is why we won't drop to 3%. As there are more jobs and more skills, the biggest problem we have is skills gap at the end of the day. That's the number one problem. Even if we need code programmers, even if we need plumbers and electricians, welders, et cetera, you can't get them overnight. Certainly nobody in this room would want to touch a welding iron if they weren't trained, because they would probably burn a part of their own body off, which is not a good thing. Take care. Thank you very much.
This is the 10th year that we organize this event, and as you can see from the attendance and the quality of the presenters, this is a main event for global shipping taking place in New York. It was one of the major investment and finance conferences that take place in New York about global shipping. We're gratified that today we celebrate the 10th anniversary of this event, and this event is known for bringing together the elite of the global shipping industry with the elite of the investment and finance world. So this is a very critical time for shipping. Some of the segments of the shipping market are doing very well, some are not. The market volatility always creates opportunities for ship owners and also for investors. And our forum, which is the first one taking place after the annual results of the publicly listed companies, debates every year the most critical and timely topics that concern the shipping industry, the finance world, and the investment community. So we are absolutely gratified to also have with us at this 10th anniversary Citibank as a partner in the organization of this event, as well as a tremendous list of global organizations that are actively involved and support this event. Nikos, the chairman of Intertanko, is going to deliver the keynote speech and talk to us about what is happening in the tanker industry, one of the major global industries. And also we are gratified to be able to recognize Martin Stopford, the president of Clarkson Research Services. Martin has a long and unique career and has contributed immensely to the global shipping industry. So we are really humbled and privileged to recognize him today. All in all, I am thrilled that for another year we put together a top event. I think it's considered as the event with the greatest investor participation. So I'm really happy to see that every year we keep delivering top-level events.
What are your future plans?
I forgot to mention that this year we are also extending our presence to Shanghai. So now Capital Link is organizing 12 investment conferences every year, and these conferences are in London, New York, Athens, Shanghai, and we're also looking into Oslo. I would like to make people understand that Capital Link is not in the conference organization business, despite the fact that we do organize 12 large-scale conferences a year. The business model we have is that the public awareness and Rolodex building from these public events feed into the private side of the business and allow us exactly to be known to a large investor universe and thereby execute for the individual clients on a private level. So our future plans is simply to continue doing what we do, expand prudently, and hopefully always try to deliver the highest quality for this platform that I think has become a unique networking platform for the global shipping industry.